What is up, ladies and gentlemen, boys and girls, real estate agents, loan officers, appraisers, clients, and title companies, and possibly my mom as well. Thank you for tuning in to watch another Monday market update in this topsy-turvy economy, this topsy-turvy world we live in, where we try to make sense of what's happened, what's happening, what's going to happen, and how we can be of service to you and in leading you through your home buying, home refinancing lives. That's our goal. My name is Sean Grapevine. I'm a VP of Product Strategy here at UMortgage, and I am joined by the one, the only Matt, the mortgage guy, Gougé. Matt, how's it going, buddy?
It's going pretty good. Yeah, I just wanted to double down on what you said, where, in this world where, one, it's volatile, and two, it's just hard to trust a headline. I am a champion of the layman. I just want to, bring people information, one, in straightforward terms they understand. Sometimes I got to translate, or I got to look up some of these fancy words that Sean Grapevine uses. But, in general, people are reading mortgage headlines. The, companies that are putting out headlines and articles really want people to click. So sometimes the things can be a little bit misleading, but we're here to break it all down for you so you understand it. What does it mean when the Fed's meeting on September 18th and they're cutting the Fed funds rate? What does it mean, this NAR settlement, what's going on with real estate agents? What does that look like on the front lines with people that are writing transactions every single day and dealing with real estate agents every single day? So I know for sure the feedback I get, generally speaking, is thank you. That was something I didn't understand. I surely didn't get a better understanding from, mainstream media's clickbait titles and the articles that were written about an industry that maybe the journalists that wrote about it have never lived in or been in or understand at all. So with all that being said, happy Monday to you, buddy.
Happy Monday. Happy Monday. Matt, you are for the layman, but you are not a lame man yourself. Guys, if you have any questions in the comments about the movement of rates, the economy, how that affects home buyers, anything along those lines, the recent National Association of Realtors settlement that has come down the pike, please put them in the comments. We would love to answer them for you. But I have a question first and foremost. Matt, how was your weekend? What'd you do?
My weekend was great. Opening weekend of football. To be completely honest, I haven't been super into football over the last few years, but my sons joined fantasy football league that's for all kids. So they're excited about football, which makes me excited about football. It's all the kids that they play baseball and basketball and,
that's super fun.
At the neighborhood.
We didn't have that when we were kids.
Yeah. So we invited everybody over, watched some football, swam, had a good time. Yesterday, we saw the new Beetlejuice. That was a cool movie, dude. Did you see that movie?
I haven't yet. No. It was
the new
good?
Beetlejuice is out, and it is good.
Huh.
Yeah.
All right.
Seems like something that you would like. It's a little bit weird, and I feel like me and you appreciate weird.
Yeah, that's true. That's true. All right, I'll be on the lookout for it. Maybe my wife loves going to movies. I'm not crazy about it.
Take her to the movies. Take her to the movie, Sean. It's a good one.
I will.
It won't disappoint.
I'll say this is from Matt.
Yeah.
This This
And
date
if she
is
loves
sponsored
it, great. If she doesn't, then, just blame it on me.
This date is sponsored by MTMG. I too, I was hurt by the Falcons, the Atlanta Falcons, when they lost the Super Bowl to the New England Patriots, where they once led 28-3, all those many years ago. At the beginning of this year, we signed Kirk Cousins. I said, I'm ready to be hurt again. But you don't really know whether you're ready to be hurt again until your franchise quarterback throws 3 interceptions, gives up a fumble, and loses 18-10 in the Georgia Dome, or whatever we call it now, the Bins. So that was a tough loss. But other than that, I had a great weekend. My wife's been out of town for a while, and she just got back home. So excited about that. Let's dive into the numbers, shall we? We got some good questions coming in here in the comments, so we won't spend too much time on these numbers so that we can get to everybody's
We'll
questions.
get to the questions for sure. So hang tight. I got good answers to your good questions.
So let's take a look at this line. Finally, we've got, what I like is that we've got steadiness. When things change, it hurts when they change too much in either directions. But if you take a look at where rates are right now compared to where they were in early June, just 3 months. 3 months ago, you will see that rates have come down from about 6.99 all the way up to 7 to somewhere in the low to mid 6s, and it's been a blessing. But it comes with some caveats. The reason rates go down is typically in response to poor economic news. And last month we had a very dismal jobs report. This month we had a not as dismal, but we had a tough jobs report where only 150,000 jobs were created, which is fewer than any other month in the last 3 years, other than the prior month. And so as a result of that, we've seen rates go down and some whisperings and confirmation that the Fed is indeed going to lower their rates in the next Fed meeting. Matt, when is that Fed meeting?
That Fed meeting is September 18th, which is next Wednesday, based on my calculations. So Wednesday, the 18th of September. This is probably the most anticipated Fed rate meeting we've had in a long time, because there's a lot of talk about rate hikes. And this is a good a time as any, Sean, to be crystal clear with everybody listening. The Fed increasing the Fed funds rate, like I made a little short form video about this last week. We already know that. Right now, any analyst who's looking at this is just trying to decide, are they going to cut 25 basis points or 50? I don't know what the latest numbers are, but Sean, quick like lightning over here, pulls them up for me. It's something like 70% think we're only going to get a quarter, 30% say we're going to get 50 basis points in next week's meeting. And so here's what people should understand. Mortgage-backed securities, mortgage rates already have this rate cut baked in, right? If there's correlation between the Fed funds rate and mortgage interest rates like there is, know that all the information that we have, the makers of that market also have. And so when the Fed cuts 25 basis points next Wednesday, if that's what they do, it's going to have no impact and maybe even a negative impact on mortgage interest rates, because we already know a cut is coming. If they cut 25 and they're like, hey, listen, we're going to take this really slow, and based on what they say, the mortgage market doesn't like that, we might see rates tick up. And people are going to say, what happened? I was waiting for 18th when rates were coming down. Trust me, Sean, I've heard this a lot. Hey, should I wait until the 18th until mortgage rates come down? And I don't blame people, because there's so much information out there in this big,
it does
wide
make
world.
It seem like they're going to lower rates, so rates should go down.
Exactly. Yeah. But that's not the case. That's what people need to understand. So, quite frankly, the whole year of cuts, whether we get 2 or 3 or 4, is pretty well baked into mortgage interest rates. I don't expect mortgage interest rates to go down a ton. The only thing that's going to affect them in a major way is if there's other economic news that's surprising that we didn't anticipate, or there's a big 50 basis point cut by the Fed, and then they say a bunch of stuff about being, super aggressive, which they probably won't. And so just keep that in mind. There's no event really that is going to take mortgage interest rates to 5.5% like next week, in my opinion. And so people that don't understand it or aren't looking at it are like, well, maybe I'll wait a week and rates will be a 1% lower.
Yeah,
Not going to happen.
I agree. You might see some things like even CPI. So the inflation measure is supposed to come out this week, or is going to come out this week on Wednesday. Those, like, something huge would have to happen to have a big effect. And even seeing, a bad jobs report followed by a horrible jobs revision. So we had a bad jobs report last month, and then it came out a couple of weeks later that they were like, actually, we need to revise down the whole last year of jobs reports here, minus 1 million jobs, essentially. And even that, I mean, it had a significant effect on rates, one of the biggest we've seen in a while, but it was still like, oh, rates went from 6.43 to 6.21. It was like, this is some of the worst news we've had in a long time. And it was like, yeah, it made an effect. It made homeownership more affordable for a lot of people.
Right. An eighth in rate too is what you're saying. Like dramatic info
for us
that came out and the humongous swing which led mortgage interest rates to crumble, to crash 1/8 of 1%.
Yeah. Which was fun for us, but I think that we think it's much bigger than your average person is.
Well,
like,
every single article that comes out paints it that way, and I think that's why the average consumer sees it too. And people call me and we go through a scenario, and I'm like, yeah, for you it makes sense. You don't want to pay too much up front, maybe 6.375, and they're like, oh my gosh, rates are that high, and I'm like, what have you been reading or smoking or both? Right? They're like. They see one headline and they think we're at 499.
Oh, I think, yeah. And for anybody who wants a timeline for how to get there, pending no future global pandemic or, great upset that is way worse than mortgage rates going down. If you're looking for 5% without having to pay an arm and a leg, you're looking at well into next year, late next year. Again, I mean, if ever.
Yeah. Right. Q4 of 25, maybe Q2 of 26, but not friggin' December.
Yeah. Which is, healthy. It's good. It's good to do this in
slow and steady, baby.
So you'll see on these charts here, ladies and gents, we have basically each one of these is the step down the Fed can take right now. I won't go into it, but the current rate that they offer to banks and the overnight federal funds rate is 5.25 to 5.5, or as expressed here, 525 to 550. And they give these ranges instead of just a single number. So everybody in September, all traders, the probability, 73% probability that we're going to have one step down, 27% probability that we'll have 2 steps down. So my guess is Fed doesn't want to upset the apple cart. They're going to kind of just play into what the investors expect. You'll see here, though, that we do have another Fed meeting, skip October, and beginning of November, odds are that there are 4. Is that right? No, 3 steps down here that you would see a third step down or second step down. So 2 total or 3 total are the odds on favorites here, which is interesting to me because using my brain and my deductive reasoning skills, that means that most people think there will be a single step down in the next one and then a double step down in the following one. Again, I think traders get kind of optimistic and they hedge towards the big event. And typically these things come back to, like you'll see here, it's like if you would have looked a month ago, you would have seen that only 50% of people thought there was just one step down. And it was a 50-50 chance. And then as things have become more clear, they've kind of migrated towards calmness and stability.
Reality, you might call it, right?
Yeah, exactly. So I would expect
I feel like I'm becoming Sean Grapevine, dude. I used to be one of the crazies, and you're bringing me back to reality.
Thank you. Wow. Yeah, I'm so glad I've had a positive.
Shout out to having smart friends. If you wander too far off into fantasy land, they slowly pull you back and they go, Matt.
Wow. All right. Well, let's not go too far. And if you look all the way into December, which is as far as I've gone here, is you'll see this is the third step down. This is the fourth step down. So odds are 4th or 5th step here by December. Again, if there's 5, that means that we have a 1, a 2, and a 2. And to me, that just nothing in the economy is screaming like we need to crater interest rates, because the Fed needs to keep these arrows in their quiver for when things actually bad things happen. Like losing jobs is bad, but like we're not hemorrhaging them, right? Like
Yeah.
when an economic crisis hits, the only arrow in the Fed's quiver are these steps down to zero. And like after that, there's nothing they can do except for buying trillions and trillions of dollars in assets.
You know what's interesting to me, quick side note here, is that, here's more proof that like we know rate cuts are coming. There's nothing on this chart for 1 or 2 rate cuts in 2024. So anybody who's like thinks that cutting rates once or twice, 25, 50 basis points is going to affect mortgage rates, like it's 100% certainty per this, guesstimation, Fed watch tool that we have at least 3. 3 is like the smallest amount.
And 3 is the least likely according. So, but again, this means one of those meetings they have to cut twice, and I just don't see it. They've been so careful. So, yeah, interesting stuff. Well, and that, my friends, are the numbers for today. So we've got some people strategizing here in the comments about how to best handle and strategize.
I love this question from Gypsy Tree. And there's so many people in this situation. I wrote this down. I think I'm going to make a video. So if you look on Matt the Mortgage Guy YouTube channel the next week, there's probably going to be a video. When should I refinance if I have a temporary buy down? That's Gypsy Tree's question, which I love this question. Gypsy Tree. So many people in this same scenario, either a 2-1 buy down or a 1-0 buy down. In your case, it looks like you did a 2-1 buy down in November of 23. And so 6.99 is the quote unquote terminal rate. You started at 4.99 in November of 23, which goes to 5.99 in November of 24, and then 6.99 in November of 25. Some people don't know this, but I'm stoked for somebody like Gypsy Tree who got a temporary buy down. When you refinance Gypsy Tree, any unused portion of that buy down is going to be refunded to you. Principal pay down. It's going to help pay down your loan. And so I like how you phrased it, because like, how do you want to play it to be able to use the remaining credit? Should we wait until we're sub 5.99? That's what my gut kind of tells me, is that right now you're paying a payment that's attached to a 4.99 interest rate. And if you tried to refinance now and not pay a bunch of points to go 6.25, not something that I would do, like increase your interest rate for the time being just to be locked into a 30 and gets back some of this temporary buy down, that's sitting in an escrow account. So I think that's probably the play, and it'll probably align perfectly. If we continue to see rates trickle down, like me and Sean talked about, not a huge jump, but a little bit of jump, let's call it December, you can get a 5.875 for 0 points, or even January. You've now clicked up to 5.99. Per your other comment you left here, you've paid $40,000 down in principal. So when we do a refinance, because you owe less, your payment's actually going to come down from the 5.99 that you're going to jump to this November. And you're going to be locked into a 30-year fixed, 5.875. You might have 11 or 12 months of subsidy that's going to get refunded to you as a principal pay down. So that honestly is going to pay in essence a lot of those costs that usually go into refinance, whether that's title fees or prepaying tax and insurance. And so that's going to supplement that. And here's where it's going to be interesting over the next, call it 12 to 36 months. As rates are coming down, people are trying to time it. In your case, I think under 5.99 makes sense. Lock in a 30-year fixed. That way it's, never has the chance to go into 6.99, recoup some of that cost. Where people get kind of sideways, Sean, is what if rates go to 5? Like me and you talked about. If that's Q4 of next year or Q2 of 26, who knows? But depending on the loan size, for example purposes, let's call it 500,000. This refinance is going to make sense for you. Lock into a 30, get sub 5.99, recoup that temporary buy down, and then if 5.875 to 5% saves you another $4,600 a year, and you can get that for a small cost 12, 18 months later, you should do that as well. But you're not going to wait hoping that it gets to 4.99. and it might never get there, right?
Yeah. In fact, like in your situation, Gypsy Tree, I would say like you have another comment in here about you paid 40,000 in additional principal so far and plan on bringing more money upon refi to eliminate PMI. Like to me, every time you refi, it costs money. But like Matt said, you don't necessarily want to wait for a time that may never come. It's like you can't tell the future. So you should refi when it makes sense, when like the cost is paid off by the monthly savings in a matter of, 12 to 36 months. Like that's when it's worth it. And even if you have to do it again, it's like you just didn't know the future. Like you didn't know whether rates were going to go up or down. So it's definitely worth doing it. In the case that you do have cash and like you want to just do this once and get it over with, I don't think Matt and I are either like very big fans of like giant rate buy downs. But I think in your situation where if you have cash on hand, if you're in your forever home, and if you can make sure that the payoff, right? So even if you pay something like $15,000 in points, and it saves you, let's say, man, this is going to be tough, $300 a month, right? Then that's a 50-month payoff period. That's a little longer than most people. It's like it's going to take 4 years to like recoup the cost of paying the additional money. But it's like then you could maybe be at 4.875% and just be like, good, I never have to think about this again until rates get to 3.875.
I love that advice. Yeah, because I think a lot of people, generally speaking, too, like set it and forget it feels good. And I'm all for that advice, Sean, in this scenario where you're looking at a refinance and you've got enough to pay down the principal and PMI is going to be wiped off. If in that same thing, and it's a conversation too. I've done more of this lately, Sean, where I'm just giving the information. I'm not going to tell a person, hey, listen, don't, spend this much to buy the rate down. Because to your point, especially if you buy it down to 4.875 or 5 1/8, who knows if we'll ever get there? What if rates stabilize at 5.5% and they're 5.5% for the next 9 years? And you told somebody not to buy it down to 5 1/8, right? Like,
yeah, and typically like if you don't have cash on hand or you need to stay liquid, which a lot of people are in that situation, it's like spend as little money as possible on your refi, like, and then just do it again once it's like you can do it without having any cash come out of pocket. Like that for your typical person, that's the advice. I will say though, you don't want to get caught with a loan officer who wants to just like send you through the refi washing machine and give you a refi every time. Like it kind of makes sense. So it's,
Right.
Well, we can get you to 6.25. Oh, now we can get you to 5.65. Now we can get you to 5.2. And it's like the only person that's helping is the loan officer. Like it's costing you a ton of money. And they're making a lot of money. So yeah, it just depends on like, you got to know how long you think you're going to stay in the house, or if you're going to keep the house once you move out of it and turn it into a rental property. All the more reason to just like hammer down the interest rate all at once, set it and forget it, and then never have to worry about it again, and really bump up your cash flow too if you do think about renting it in the future. Because I don't think most people know this, but if you leave your primary residence, you don't have to refinance it into an investment property. You could just rent it out at whatever rate you currently have.
Yeah.
And that's a key way to build generational wealth. So let's move on to this next question here. J Mess 503. Matt,
purchased a property back in June. Go ahead. I'm sorry.
I purchased I purchased a property in June with cash. Okay, well, no need to brag, J Mess 503. Looking to do a cash out refi. Can't do a conventional, or can you, until December? Would you do a DSCR right now?
Yeah. Well, yeah. I like how you led me into this. Like, but can you, right? Because you should be in a position to do delayed financing. And I think that's what you were alluding to, Sean. And so I would talk to you about that. I think I can answer the other part of the question really easily. Like if you thought about doing, hey, let's do a quick DSCR and then we're going to do a conventional. Never would you do that. DSCR is a great product for people that don't qualify for conventional, but generally speaking, always comes with points. Generally speaking, has a prepayment penalty. And if you don't want the prepayment penalty, you buy out of it. So that would be a really expensive interim loan if you couldn't. But reach out, because you should be able to do delayed financing is what Fannie and Freddie call it. For I bought something cash, I want to pull my cash back out of this property with a cash out refinance. There are caveats to that on what value you can use and how much you can get, based on how much you purchased it for. But you know what I would do if I was you, JMS? I would go to greatmortgagebroker.com. I'd fill out that quick little form. I would connect with somebody who Matt highly recommends, which is either somebody on my team or another great UMortgage loan officer that covers 48 states. So no matter where you're at, JMS, if you go to greatmortgagebroker.com, we can set you up.
Look at that.
You've never been to greatmortgagebroker.com, Sean?
I'm so sorry.
It's okay. It's okay. Well, no wonder I never shot you no Atlanta deals.
Oh, yeah. That's all right. You can have them.
It's all right.
Ben Bell can have them.
Yeah.
Yeah, no, I think delayed financing is definitely the way to go. There's no restrictions on, it sounds like this is probably an investment property. No restrictions on primary residence versus investment. You can get back the entire value of your purchase depending on a couple things, but you can at least get back 75% of the purchase price. And then you can typically, like if you've done work on the property, you can bring the receipts and get like that amount back up to the original purchase price of the property, unless things have changed since I last.
Well, I wouldn't necessarily share that, because in my experience, it's really hard. It's got to be like on a settlement statement, which isn't always the case when somebody does repairs and stuff. And so, that is less frequent that somebody's able to recoup some of those construction costs, because it's not wrapped into the settlement statement in the purchase. But at least, explore the conventional options, which is generally the path people lead. It's like, hey, if I can't get conventional, I'll go DSCR. But if I can get conventional, it's the cheapest, best money out there. So yeah, we'll take a look, JMS.
Yeah, don't listen to me about mortgage guideline. I'm rusty. I'm out of practice. I'm just a product strategy guy, not the product guy anymore.
Just in there with the tech, man. Just creating mortgage revolution on the tech side. I love it.
Easy. Well, Matt, that is all the time we have for today. JMS, Gypsy Tree, everybody else, Kevin Hawthorne, thanks for hopping on. Always great to see you guys in the comments. Next week, we will have our Fed preview episode, and then the following week, we will have our What the Fed episode, where we go over what happened during the
Fed. And we'll see if we were correct. If we were correct about
all right. Let's put our money where our mouth is here. One rate cut, and the projection of like we're going to take this slowly in the minutes. You think? I mean, we probably agree on that.
Maybe, yeah. One rate cut. I don't know about their take it slow in the meeting. I think.
Yeah, maybe. I mean, they could say we're going to do whatever's necessary to.
It's going to be a bunch of gobbledygook about the economy and data and waiting to see. And
well, that's what I'm saying. Yeah, I think. Yeah.
All the gobbledygook, but we will report back and we'll translate the gobbledygook to normal person speak for our esteemed guests here on the show. Thanks for watching.
Matt, I hope you have a great rest of the day. Viewers, listeners, hope you have a great rest of the week. See you guys next week.
Thanks, buddy.